and welcome to this special Market Guru. I have with me today Tarun Kataria. Thanks very much, Tarun, for coming by. I remember we last spoke about 6 months ago, and I just want to first go back to some of the issues we talked of and see where we've come so far. And a lot has happened in these last 6 months. I remember the first question that I put to you 6 months ago was on, there were certain very euphoric targets that were being put out on the Sensex hitting 30,000 in 18 months. Of course, I'm sure those people are now regretting having said all that. No, you didn't. But what you did mention was the fact that 23 to 24,000 by the end of the fiscal was something that you said is not unlikely. Of course, you caveated it by saying that there is a lot of global developments out there that are going on. USA is in a transition. Europe is having its share of problem. We've got our own headwinds to deal with. And I want to pick on each of these three where we've moved as far as those are concerned, and then I'll come to whether you are still sticking to that target or not. Europe seems to have only gone worse in the last 6 months, hasn't it?
Yeah. I think Europe's got a couple of problems, and I think I might have mentioned this the last time. You've got to sort of structurally the euro is flawed, and I think I actually did a piece for one of the magazines 15 years ago saying you can't really build a currency around saying I want a market to compete with the US and then not align everything else. So that's a problem. And obviously in the meantime you've got 17 divergent economies with different agendas. You've got political paralysis. So yes, Europe is in a problem, and the other structural issue you've got is declining populations, right? So your pension bills, which nobody's really talked about thus far, still is a problem that needs to hit the press, if you know what I mean. So you've got a long-term problem. You've got a secular decline in Europe. So this is sort of massive noise in the meantime which needs to be resolved, but assuming that it is, you've still got the same very long-term fundamental demographic lack of sort of income creation, declining population birth rates, all that in Europe still.
Is it a worrisome situation for you?
It's extremely worse.
And has it gotten worse in the last 6 months? What we've seen, we thought it was Greece 6 months ago. Today it's Italy. It's a far bigger economy.
Yeah, you've got the markets which are now fearing, Greece to Italy to France. Why should France be a AAA economy, right? Why should Italy still be a single A economy? So all that stuff needs to filter through. But the other problem is, as long as they continue to dilly-dally, the underlying macro situation starts to deteriorate, in fact has started to deteriorate. That again is a sort of second round of pressure on bank balance sheets. That still has to come. So you've got a long-term, this thing continues for quite a while. So you might resolve and say, okay, you've got a new sort of new government in Italy, you've got a new government in Greece, G has gone away. The spike in wars might go away, but the underlying situation remains pretty tenuous.
Coming back home, the big headwind that we spoke of and has been a headwind was inflation and the tightening. You did mention you were hopeful that inflation would probably peak in the third quarter of the calendar year. While yes, there seems to be a general feeling that we've got it under control, but it still remains high. The RBI, on the other hand, while it's indicated that we are probably done with the tightening and we're going to pause, there is still the jury out there which says if this doesn't come under control, the inflation. And I remember last time you raised the point that you can keep doing what you want to do as RBI, but the fact of the matter is there are supply-side constraints. Nothing seems to have moved on those.
Actually, you're right. Nothing has moved. In fact, I suspect if you sort of do some research, I would have thought in the last several months, infra projects have probably come to a standstill. Financing seems to be an issue. There's too much scrutiny on large-scale financings of PSU banks into this sector. So I think if it was worrisome then, it's probably, to me personally, much more worrisome today. So that again is a long-term feeder for, while the base rate might come to 7%, which is what we're all trying to convince ourselves, the fact is inflation in this country is well into double digits. If you've got inflation well into double digits, you've got cost of money at 16, 17, 18, 19%. Very hard to run companies, very hard to run an economy. So in fact, the headwind to my mind is a bit stronger at the moment.
So if the concerns have become only stronger, both whether it's Europe and global as well as back here, you are less bullish today than you were 6 months ago?
I'm less bullish today, yes.
To what extent?
I mean, again, if you believe that the 7% number is a number that the market hangs its hat on, saying inflation is peaked, now whether base rate or the fact that inflation is still rampant, if that's peaked and you have new allocation from the FI investors come the new calendar year, you could see something a move up in the markets. Question is, would it be sustainable or not? Unclear to me. 23-24 probably looks like a bit of a stretch at the moment. But again, as I say, if there is a true belief that inflation's peaked, PSU bank stocks massively, sort of not massively, but still undervalued.
They would run, autos would run if all of that happened. But if you combine that with the global concerns, and you made the point last time, and which is what it is really, that our markets really move on the way global factors or the FIIs move. If that be the case, Tarun, would you say that you've sharply cut? I remember I asked you this question a few times and you remained bullish last time when we saw. Today I don't get that feeling.
No, I'm not nearly as bullish as we were at the time. I would say if we see sort of 21,000, that'd be a good outcome.
Okay, let me move to the other side of it. I remember having asked you that would there be more pain before we see some kind of a recovery, and I remember you had mentioned 8 to 10%, and that's what we actually got to. While now we're back again at that range of 17,000. If all these factors were to implode, especially globally, the point that you made, if all those pension bits were going to start hitting the press and things were to get worse, would we see a deeper pain? Would you say another pain is around the corner? What's the minimum floor that you're looking at?
From a market's perspective?
Yes, from a market's perspective.
See, frankly, I'd like to think most of the bad news on India is in the pricing. You've got, I guess, some stability now in the US, so there was sort of not so pleasant news coming out of the US, which seems to have stabilized. You've got a talk of the Eurozone imploding, so that's pretty negative. Japan's having its share of problems. We know about sort of governance, lack of any sort of direction coming out of Delhi, high interest rates, inflation. So I'd like to think the worst is behind us. Now, can the market have spiked downwards 7, 8, 10%? The answer is yes, and that's, you've said it on many of your shows, that's the nature of the equities business, right? But I'd like to think, everything considered, we are close to that floor in our markets, and the bias, if the sentiment globally improves, will be to move higher.
Let's talk about another issue which is now beginning to come out of the closet and getting discussed in the media as we head closer towards our own budget and the end of the fiscal. And the fact is that there are concerns now on the whole fiscal deficit thing. We talked last time about the disinvestment bit. Nothing's happened. The government is coming out even more openly now and saying that I'm unlikely to meet my fiscal target. Do you think that in the next 2 to 3 months that becomes the theme and the overhang really in the market? Because till now nobody was talking about that. People were talking about inflation, interest rates, etc. And I was suddenly looking at a situation 2 months, 3 months to go where you realize that all those numbers that we had talked of, all those anticipations are not happening.
No, but I think if you believe as I do, FIIs tend to drive our markets, and I think you'll find that there's a high correlation between FII flows and our indices. The FIIs, as we had, and I hope I said that at the time, to believe a 4.6 number at the start of the year was tough. We knew that the markets would be hard. To have 10 or 20 billion dollars of disinvestment was...
You're saying they already had factored that in?
Yeah, they have factored it over the last few months, that number, the 4.6 or 4.8, whatever it is, not going to happen. It's looking like close to 5.5. Disinvestment ain't happening, which was one of the big things. I think 3G was a big sort of, elephant in the room the last time around. That's not happening. So I'd like to think most of that is factored into the market. But if it comes into the domestic press and the broker investor says, oh my God, it's 5.5%, you might have a little bit of a downdraft. But the thing to watch is the impact on the currency. That to me,
I want you to talk a little about that, because that's been one big mover and a challenge in the last.
It's been a huge mover, and there's nothing to suggest that, and this is despite having high interest rates, the currency is blown out, right? So if you believe inflation's peak, there's a bias for rates to come down, more pressure on the currency, fiscal deficit, more pressure on the currency, the capex numbers will come, IIP will come today, which our view is it's sub 2%. All these things will put downward pressure, upward pressure, whichever way, put it on the rupee to head 52.
What's the mood among FIIs, Tarun? Because if this is the fact that they had, does that explain why they've been so much out of this market? I mean, of course they are bringing in money, but the net inflows are pretty much, going to end this year dry almost. I mean,
and net negative this year, right? I would have thought.
So what's the mood? Is it more to do with the fact that they've got concerns about India, or is it more to do with the fact they've got their own problems and therefore are busy grappling with that?
No, you will have, I mean, it's a bit of both, right? I mean, the whole state of the planet's poor, right? The investors are concerned about their own jobs these days. But I think when you have India-specific funds or you have EM-specific funds, there is deep concern about India by itself for all the reasons we just talked about.
Let me come a little to the more sectoral issues. I remember you mentioned last time that as a firm, you're generally bullish on banks, IT, and auto. And I remember I posed the question to you on...
I hope you meant two-wheelers.
Oh, yes,
Sure,
that's right. Yeah, sure, absolutely. And I remember that at that time, both INFI and State Bank of India had disappointed the street with their results. But you still said, as a firm, we would still believe in these companies. On these two, do you still remain as positive? Not the two companies, I meant the two sectors. Do you still remain as positive as you were?
Yeah, I think look at us as guys who sort of, when we advise our clients, it's, what do you want to do in the next 1 or 2 years, not just sort of trading in and out. And the answer is yes. I think if you look at State Bank and you look at the PSU banks in general, are trading around sort of one times book on either side of it from time to time. Historically, they've been at least 50% up from there, 1.5, 1 point, and sometimes I think they might have even traded almost 2 times book. We need to get there. Now, that might not be the reverse to the mean. The mean might be different today, but I think PSU banks, we still think generally are undervalued. And if you believe, as I do, that there's pressure on the rupee to weaken, then INFI and TCS sort of all look interesting from an FX perspective.
But the concerns, as far as PSU banks are concerned, the NPA bit, is that something that bothers you as well? Is that something, again, which could come and hit us in our face, and it's just coming out in drips?
Yeah, I think that there is a risk, and therefore, Moody's did what it did. You're in an environment where growth is slowing, interest rates are going up. You have to have some pressure on your NPLs, right? Just by the nature of the game, you've got SMEs who are under pressure, you've got real estate sector under pressure, you've got the infra guys under pressure. So yes, you will see it. Again, a lot of it is in the market. The FIs have thought this through, many moons ago. There will be pressure, but like all good things, markets do recover. Sometimes they take longer than others. The bias again over the long term should be the right way.
One word, phrase that one keeps hearing these days, India Inc. is resilient, and even though this quarter as well, the numbers have by and large surprised people on the more positive side. What's your sense, Tarun? Is it, is there a disconnect therefore? Because, you've always heard the RBI or the government saying, we don't think growth is getting as affected as you guys are making it out to be. On the other hand, you had India Inc. saying, I'm getting throttled, I'm getting slaughtered. But the numbers, so far, don't seem to be reflecting either of the two. In fact, on the contrary, they seem to be reflecting more the government's view. So this resilient India thing, is this some kind of a lag effect, and it will probably play out 2 quarters from now, and therefore to sit smug and say that, okay, despite all of that, India Inc. is resilient. Is that a bit of a misplaced kind of a...
So if you're building an economy on stuff saying India Inc. is resilient, I think that's wrong. India Inc. and I speak to a lot of promoters, I speak to a lot of sort of CEOs and CFOs. The mood is not very good. And the flip side of that is, yes, the folks sitting in Delhi, they've got to say India is resilient. I can't, if you're going to be re-elected in a couple of years, I don't think you can come on any channel, including yours, to say, listen, this place is about to implode, it's looking pretty negative, we have no control over inflation, we have no ability to put contracts out to get our infrastructure sorted out. They really can't say that, right? So they have to drip feed over time that 4.6, the deficit, okay, it's looking like maybe 5, and then they'll get to 5.5 in the next 5 or 6 months. So that's their job. They're doing what they need to do. But if you are, as I do, talking to people all the time and saying, listen, equity markets are closed, if you're going to grow your business, even in a 6% GDP economy, and I suspect that's where it's going to get to, you're financing yourself with 18-19% money. That's exactly what he's thinking, and saying, wow, how am I going to do that, right? Yes, maybe companies grow at 3 times GDP, that's great, but most of it's eaten up by the cost of money. You can't build an economy.
So are you saying that the next 2 or 3 quarters, the numbers that are going to come out are not going to be as pleasant and resilient as what we've seen this one?
Macro numbers won't be.
No, I'm talking about corporate earnings.
See, corporate earnings, again, you've got FX now, right? Obviously, FX does one thing. Your input prices are going up. That's another thing. Can you price that into your product? The answer is at some point you can't, right? And I think auto companies are a good example of that. So I think there would be pressure for the next couple of quarters, no question about it.
You talked of, I remember we talked from a 5 to 10 year kind of a time frame, and you said that this market has it in it to give 20 to 25% earnings growth. You stick with that?
Well, I suppose if you look at it today, it's looking pretty bleak, but I would have thought and there's no reason to assume why we can't grow 7 or 8%. And if you grow 7, 8%, then 2x, 3x, that should be something that you can scoff at, something that you could certainly target to get done.
What are the sectors? I remember last time you told me you were very conservative on metals, and then you talked about the consumer-led theme, and that seems to be the big theme, continues to be the big theme.
But that's played out, right? Metals are trash. Consumer stocks are now trading at 30 times next year. So I think that has played out to thankfully to what I said 6 months ago.
Absolutely.
The question is, going forward, can you continue to, can consumer stocks continue to materially head higher from here, trading at 30 times? You've got to ask the question, right? If the market sentiment turns, do people rotate out of that, where they've had a terrific run, into some of these sort of undercooked sectors, PSU banks we just talked about? I think there's a good chance of that.
I want to ask you a question on a slightly different asset class, which is gold. As it always happens when you see an asset class rising of the way, for example, gold has done, I find a lot of retail investors calling in and now asking, should I be in equities or gold? Is that something that concerns you as well? Because, you start treating it like saying I'm going to put 70 to 80% of my portfolio in gold because it's run up so much. I mean, is that a word of caution that you believe you want to send out?
Absolutely. I'd from a portfolio perspective, and if you do your sort of corporate finance class at business school, they tell you it's all about portfolio allocation. In no bull market, at least that I have seen, you will even have 70% allocation to equities at any one given point in time. So to say, listen, I've got in a high beta, a high volatility, single commodity, to say, listen, I'm going to put 70% in gold, I'm not sure I'd advise anybody to do that. And you can see the way gold is moving. I mean, it's held up, it's what, 17 odd for the last, period of time. Can this thing trade down $200? Can it trade up $200? Absolutely it can, depending on what the dollar does, depending on what risk on, risk off is. But 70% in any asset class, bad idea.
Do you think, final question, a lot of experts say that when times are bad, when there is gloom, that's the time when you should be getting in and starting to build your portfolio. From an investor's point of view, that's the time when you're scared, and that's the time when you really sit out. Though we have seen a very pleasant trend in our own markets over the last 3-4 months, where mutual fund SIPs or mutual fund inflows have perhaps for the first time gone up and the market was down. Therefore, what would you tell an investor to do right now? Would you say there are some good valuations out there in this environment of gloom, or would you say hang in there for 6 months, let things play out, let things get a little better, and then you get in?
I think I'd probably say two things. The fixed income asset class is very attractive, right? So if in these funds you're getting something close to 10% effectively after tax, and if you can compound that for the next 7 to 10 years, 10% compounded for 7 years is a massive return. So you have to seriously think about having Indian fixed income in your portfolio. And equities, yes, we will grow somewhere between 6 and 8% for the next several years. I would start drip feeding into equities as well. But personally, equities, individual equities, are for institutions and for research guys who have the time and wherewithal to do the work that's required to pick them. I would ask certainly the retail investor to look at funds, because you're giving your money to a professional. He studies this all day long. A retail investor has his primary source of income is his job. He can't be sitting there doing research all day. So yes, SIPs or whatever these things are called, into good mutual funds, a fixed income portfolio, maybe a little bit of real estate, and if people fancy gold or commodities a little bit in gold. That's how I would go.
Pleasure talking to you like always, Tarun. Thanks very much. All right, that was Tarun Kataria. We take a short break. We come back on the other side and take your stock-specific questions.